Recently, Morgan Stanley announced in a report that the dollar could fall another 9% by mid-2026. While this is merely a forecast that may or may not come true, it is true that the dollar has already lost more than 10% so far this year. While the level of uncertainty has diminished somewhat, there are still many factors that make it difficult to determine whether the currency has already bottomed out. In this video, we will review some of the arguments put forward by Morgan Stanley and other firms for predicting that the dollar will continue to lose value. We will also try to examine what the implications may be for the markets and the S&P 500. Morgan Stanley, JP Morgan, and Goldman Sachs project that the dollar will continue to lose value due to a slowdown in economic growth in the United States. Another reason these firms predict a weak dollar is the continuation of the trade war launched by the Trump administration this year, with increased tariffs on imported products from more than 50 countries. It was precisely from the so-called Liberation Day, when the tariffs were announced, that the decorrelation between the DXY dollar index and the 10-year U.S. bond rate began. In recent years, a fairly strong correlation was observed, showing that the dollar strengthened when bond rates rose. This behavior has recently changed. Some analysts warned a few months ago of a possible overvaluation of the dollar, even by almost 15%. This trend had begun several years ago and had reached quite high levels. Along the same lines, analysts explain how the currency's loss of value is related to the lack of confidence in U.S. institutions, as explained by economist Barry Eichengreen of the University of California at Berkeley. Another reason for the loss of value of the U.S. dollar may be related to the uncontrolled U.S. debt, which already involves interest payments, with increasingly high percentages of government revenue. The U.S. debt has already reached $36 trillion, and the trend is to continue increasing. Along the same lines, although the current administration was expected to improve the situation, for now the fiscal deficit outlook remains negative, as it is expected to continue to increase in the coming years. Even Elon Musk himself dared to assert that the dollar will be worthless if the United States doesn't do something about its national debt. While historically, thanks to the tremendous demand for dollars, the U.S. government has managed to finance its debt through issuance, it seems that this time the situation is different, and the market is already viewing the measures taken with suspicion. Another possible reason for the currency's weakness is the reduction in China's share of U.S. debt. China has been reducing its share of U.S. bond purchases. In previous years, it was the largest debt buyer, but recently it has become the third largest buyer, behind Japan and the United Kingdom. It cannot be ruled out that the Asian giant is using bond sales and the weakening of the dollar and bonds themselves as part of its strategy in the so-called trade war. This trend is also observed in the image, which shows how the so-called BRICS countries have been steadily increasing their gold reserves while simultaneously reducing their dollar reserves. Analysts such as Meera Chandan of JP Morgan Chase maintain a bearish position on the dollar, even asserting that it would be better to bet on the yen, the euro, the Australian dollar, and the Swiss franc. Although the U.S. dollar remains the most heavily used currency among all international reserve currencies, it is clear how it has gradually lost ground relative to other currencies. Historically, in the face of economic or political uncertainty, the U.S. dollar tended to strengthen, as it served as a safe haven in periods of turbulence, and U.S. debt tended to rise in price while bond rates fell. This is because money was looking for a safe haven, as U.S. debt and the dollar were considered. But recently, this has not happened, and investors have not opted to buy U.S. bonds and dollars to withstand the turbulence. Among the additional factors that may also be strengthening this trend is the proposed tax reform and its controversial Section 899 bill, which would allow the president to tax foreign investors in the United States. The initiative proposes a withholding tax ranging from 5% to 30% on interest, corporate profits, and real estate gains. It is also possible that the withholding tax on dividends could increase from the current 15% to 35% in 4 years. Some analysts are even calling the initiative financial repression, as holding assets in U.S. dollars could become less attractive to citizens abroad. Another reason for the continued decline of the dollar is the possibility of a 175 basis point rate cut by the U.S. Federal Reserve. However, among the range of possibilities is also that the government and President Trump may seek a weaker dollar to improve prices for U.S. exports in other markets, boost U.S. industry, promote domestic manufacturing, and increase employment in the productive sector and exports. For some analysts, it is likely that the dollar's strength as a reserve currency has had a negative impact, leading to the country's deindustrialization, making products manufactured in the United States very expensive, and generating an increase in the trade deficit, as U.S. manufacturers have sought to export their production to other countries, reducing local industrial jobs. But other voices, such as that of Kenneth Rogoff, professor of economics and public policy at Harvard University and former chief economist of the International Monetary Fund, IMF, propose that the value of the dollar depends on many factors, and the assumption that increased tariffs are the magic formula for reducing the trade deficit may be misguided. Now, regarding the market implications, for now it seems clear that U.S. debt has lost value and bond rates have risen. However, while the stock market has managed to quickly recover, it is still too early to determine whether this rebound is sustainable and whether the weaker dollar could make U.S. assets, including stocks, less attractive to foreign investors. On the other hand, the outlook for emerging market assets could improve, as a weak dollar would tend to appreciate, while debt in these countries tends to decrease. While Europe could also benefit, the recent rebound in some stock markets would leave less room for appreciation in the case of indices and stocks in some European countries. Some emerging countries may have room for appreciation, although there is still plenty of room for further growth. In a future video, we will likely analyze some stock markets in emerging and developed countries that have quite attractive multiples to take advantage of the weakness of the U.S. currency. Remember that in the video description, you'll find the link to the best course for learning technical and fundamental analysis for investing in stocks. You'll also find the link to the best platform for buying stocks on the stock exchange, regulated in the United States. If you enjoyed the video, give us a like, subscribe to the channel, and share the content.